Brent oil is sitting above $100 a barrel, and for the first time in 3 years, the market is starting to treat it not as a spike, but as the new floor. Futures pricing suggests the market is bracing to absorb triple-digit oil for the next 6 to 12 months. 3 structural forces are keeping supply constrained. OPEC Plus has held its production cuts intact. U.S. shale growth has plateaued as drillers prioritize shareholder returns over volume, and the ongoing Strait of Hormuz tensions have kept a geopolitical risk premium baked into every barrel. That combination of disciplined supply and a persistent threat premium is what separates this oil move from a typical demand spike. Now, that changes everything. Not just for energy stocks, and not just at the pump. At the current rate, the entire S&P 500 winner-loser map gets redrawn. Some sectors are about to print free cash flow at a pace they haven't seen in years. Others are quietly walking into a margin trap with no exit. And underneath all of it, the Fed Reserve is being cornered by a commodity it cannot control. Today, we're breaking down which specific stocks and sectors benefit from prolonged high oil, which ones get crushed, and what this Brent crude cost means for the rate environment that is holding this entire market together. My name is Phoebe, and you're watching Trading Key. Who profits as oil prices surge? Let's start with the obvious beneficiaries, because this is where the market gets lazy. Most investors just rotate into energy and call it a day. But the breakdown matters enormously. As oil prices surge, the clearest winners are upstream producers, the companies that extract oil from the ground without the noise of refining margins or retail stations diluting the upside. ExxonMobil operates at a corporate production break-even around $35 per barrel. At $100, for instance, every barrel produced generates roughly $65 in gross spread before overhead. That's the core mechanic of the upstream oil business. The fixed cost base doesn't move with the commodity price. So when Brent runs above break-even, nearly all of it falls straight to free cash flow. ConocoPhillips runs a lean operation with a break-even in the low 30s, giving it some of the highest oil price torque in the S&P 500. Each dollar of sustained price appreciation translates into outsized earnings expansion relative to peers. On the other hand, Devon Energy runs what's called a variable dividend model. Unlike traditional fixed payouts, Devon's dividend has a base component supplemented by a variable portion that scales directly with cash generation. If Brent holds above $100 for 2 consecutive quarters, Devon's effective yield could expand materially, making it not just an oil price play, but an income compounding machine. That structure makes Devon one of the most investor-aligned ways to express a sustained high oil thesis. The sector that's slept on in this environment is oilfield services. When oil prices surge, their first instinct is to reinvest in drilling programs and new well completions. That accelerated capital spending flows directly to Schlumberger and Halliburton, which supply the rigs, wireline services, and pressure pumping technology that converts a favorable commodity price into actual new production. Historically, oilfield services revenues lag upstream profit surges by roughly 1 quarter, then accelerate sharply once drilling programs ramp. That lag is your entry window. The trade logic here is simple. Sustained high oil is a revenue guarantee for producers and a forward demand signal for the companies that help them drill. Transport stocks are under pressure. Now, let's talk about who is structurally exposed to this environment, because this is where portfolios quietly bleed out with no obvious warning sign. Jet fuel is not a minor cost line for the major carriers. It typically represents between 20 and 30% of total airline operating expenses. As Brent surges above $100, jet fuel is running roughly 40% above its decade-long historical average. And unlike labor contracts or aircraft leases, this is a cost that airlines cannot defer or renegotiate away. United Airlines, Delta, and American Airlines all entered 2026 with fuel hedges covering less than 20% of their projected annual consumption. Southwest has historically maintained a heavier hedging discipline, but even Southwest buffer erodes as existing contracts roll over at spot prices that are structurally elevated. For United specifically, a $10 per barrel sustained increase in jet fuel costs translates to approximately $1.5 billion in additional annual operating expenses. At the current rate of Brent cost, we're looking at a cost shock roughly 3 times that magnitude against 2023 fuel levels. Margins don't gradually compress under that scenario, they collapse. Now, the damage extends well beyond the terminals. The broader transport and logistics sector is facing a diesel squeeze that directly hits trucking companies like J.B. Hunt and Werner Enterprises. Unlike airlines, these carriers operate on already thin margins in a freight market that is still working through a demand soft patch. FedEx and UPS both have fuel surcharge mechanisms built into their contracts, but surcharge recovery lags spot fuel prices by 2 to 3 quarters. That gap means multiple consecutive quarters of margin compression before pricing adjustments can take hold. If you are holding transport names, the question isn't whether margins will fall. It's how deep the crater goes before the industry can reprice. Oil, inflation, and the rate domino. Here's where it gets systemic, and this is the dimension most equity investors miss entirely when they think about oil. Brent Crude's price surge doesn't just create winners and losers in energy and transport. It rewires the entire interest rate framework with cascading consequences for sectors that have nothing to do with petroleum. The data tells the story clearly. PCE inflation, the Fed's preferred gauge, is being now cast at 3.5% year over year by April, up from 2.8% in January. That is a 70 basis point reacceleration in under 3 months, driven in large part by energy pass-through costs filtering into transportation, food distribution, and manufacturing inputs. But the more alarming signal isn't the backward-looking inflation print, it's the forward-looking one. Year-ahead consumer inflation expectations have jumped to 4.7%, the highest reading since September 2025. When expectations start moving ahead of actual inflation, the Fed's job becomes exponentially harder. Expectations become self-fulfilling. If consumers and businesses believe prices are rising, they demand higher wages and raise prices preemptively, and the cycle feeds itself without the commodity doing anything further. The institutional consensus has already updated its rate outlook in response. A Reuters poll conducted between April 17th and 21st found that 56 out of 103 economists surveyed now expect the Fed Reserve to hold rates through the end of September. JP Morgan has gone further, explicitly stating that the Fed will hold at the April 28 and 29 meeting, and likely through the rest of 2026. This is a complete reversal from the rate cut narrative that dominated market positioning as recently as January, when consensus was pricing 2 to 3 cuts for the year. That narrative is effectively dead. The hidden casualties in your portfolio. Now, here's what a Fed in permanent hold mode means for your portfolio beyond the energy trade. The first casualty is rate-sensitive sectors, which had been quietly pricing in cuts that are no longer coming. REITs rely on cheap debt to fund property acquisitions, and with the Fed anchored, their financing costs stay elevated, while their dividend yields compete unfavorably against treasuries. If a 10-year treasury is paying 4.5% with zero volatility, institutional capital has very little reason to take on real estate risk for a 3.8% REIT yield. That re-rating will be gradual but persistent. Homebuilders face a compounding version of this problem. Mortgage rates stay stubbornly above 7%, which keeps affordability broken for the median buyer. Lennar and D.R. Horton had been counting on rate relief to thaw demand. Instead, they're sitting on incentive-heavy inventory against a buyer pool that cannot afford the monthly payment. Utilities face the same treasury competition problem as REITs. They offer stability but not yield advantage, and in a higher-for-longer environment, that makes them an unattractive destination for defensive capital rotation. The one partial exception in this rate-sensitive group is regional banks. Higher for longer preserves their net interest margin, the spread between what they pay depositors and what they earn on loans. But this upside is capped by a credit quality risk. If sustained high oil and stubborn inflation push consumer financial stress higher, loan delinquencies begin to rise. And the loan book starts deteriorating exactly when the margin story looks most attractive. That tension makes regional banks a selective opportunity, not a wholesale rotation. Positioning your portfolio for oil surges. Here's the honest summary. As Brent crude prices surges, you have a clear upstream winner complex in pure play producers and oil field services, a transport loser complex in airlines and trucking, and a macro overlay where the Fed's frozen posture acts as a silent tax on every rate-sensitive sector in the market. The worst portfolio position you can hold right now is a highly leveraged, interest rate-sensitive company with meaningful fuel cost exposure. That profile describes the major airlines almost exactly. So the real question is, how are you repositioning for a world where $100 oil is the baseline, not the headline? Are you rotating into upstream energy, trimming REIT and homebuilder exposure, or holding cash and waiting for the first crack in crude prices to reverse the entire dynamic? Let me know your thoughts in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key. Give this video a like and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.